Hello students, welcome to my channel GK's Education. As you all know, partnership accounts is going on, and in previous videos we were doing the various methods to value the goodwill. Now in this video we will do the treatment of goodwill, that is when the goodwill is valued. When the goodwill is properly valued, then what will be treatments to be recorded in the books. So that is what we are going to do in this video. Here we can say the incoming partner who takes his share in the profits of the firm from the existing partners brings in some additional amount to compensate them for the loss of their share in the super profits. It is called his share of goodwill. We have done this that whenever the new person or a new partner enters, definitely he brings with him some amount of cash which is called goodwill. So uh, here alternatively, he may agree that the goodwill account is to be raised in the books of the firm by giving necessary credit to old partners. As you all know that he brings some amount in cash as goodwill, so it may happen that a goodwill account is to be raised in the books, and the proper credit to be given into the partners in their old sacrificing ratio or in their old profit sharing ratio. So when the new partner is admitted, goodwill can be treated in two ways. There are two ways of treatment of goodwill in books. So these are: number one, by premium method, and number two, by revaluation method. Here in this video we are going to do only the premium method. The revaluation method will be covered in the next video. So by premium method, this method is followed when a new partner pays his share of goodwill in cash. The amount of premium or goodwill brought by new partner is shared by the existing partners in their ratio of sacrifice, as we have done in all the examples. Now the amount is paid to old partners directly by the new partner. No entry is made in the books of the firm. So here the treatment starts in one case if the amount is paid to old partners directly or privately by the new partner, so no entry is made in the books. Number two, when the amount is paid through the firm in cash, the following entries are passed. Number second case is when the amount is paid through cash through firm. That means it is paid through the firm. The following entries are passed in the books. These entries are: number one, cash account debit to goodwill, amount brought by the new partner as the premium when the partner brings a premium or when he brings a goodwill. And then goodwill account to existing partners capital account individually. The goodwill is divided among the old partners in their sacrificing ratio, or if not any ratio is given, in that case in their old profit sharing ratio. Alternatively, there are two types of treatments which we can give, or we first chances we can treat it like this, or in second chance the goodwill amount is credited to the new partner's capital account and then adjusted in the favor of existing partners in their sacrificing ratio. In that case, the entries will be cash account debit to new partner's capital account when he brings the amount of goodwill, and then new partner's capital account, it will be debited with the goodwill share only to existing partners capital's account individually to each partner. Goodwill brought by the new partner is distributed among the old partners in their sacrificing ratio. That is to be kept in mind very carefully. If it is not given, we have to calculate it. Now, here are again few cases for the treatment of goodwill. First one is if the partners decide that the amount of goodwill credited to their capital account should be retained in the business. It has to be retained in the business. In that is, there is no need to pass any entry. Matlab, if the amount is retained in the business as it is, then no entry will be passed. Second case, if the partners decide to withdraw their amount in full or part, the additional entry will be passed. So if the partners decide to withdraw their share. If for full, then the entries will be with the full amount, or in part, or if in part they decide to withdraw, then the entries will be passed in the mm, and with that amount we can see. So the additional entry, that means when the partners brought in, when the new partner brought in the capital, then these two entries, the basic two entries will be there, and one additional entry if the existing partners withdraw their capital. So in that case, the additional entry, that is additional entry number 3, will be existing partners capital account individually to cash the amount of goodwill withdrawn by existing partners. Now these points will be more clear with the help of this example. Here, A and B are the partners in the firm sharing the profits and losses in the ratio 5:3. Now C is admitted for 1/5 share. He has to bring 20,000 as capital and 1/4 as his share of goodwill. Now give the entries. Here the various uh, conditions are there. Number 1, when the amount of goodwill is retained in the business. Number 2, when the amount of goodwill is fully withdrawn. Number 3, when 50% of the amount of goodwill is fully withdrawn. Now first case, when the amount of goodwill is credited to existing partners and is credited to existing partners is retained in the business. In that case, the entry will be cash account debit to seize capital for the amount of capital, to goodwill account 4,000 for his share of goodwill, being the amount brought by C as capital and goodwill. Now second entry will be goodwill account debit to A's capital account, to B's capital account, in their ratio 5:3, that is 2,500 and 1,500. Here the amount, here it is assumed that they will share the goodwill in their profit sharing ratio. Good, these accounts. And then number second case is when the amount of goodwill credited is to existing partners is fully withdrawn. When the amount is withdrawn, in that case, first entry will be same, that is this one entry, cash account debit to seize capital to goodwill. Second will be same, that is this one entry, goodwill account debit to A's capital to B's capital in their profit sharing ratio. And additional entry for the withdrawal of goodwill will be A's capital account debit with 2,500, B's capital account debit with 1,500. That means the total amount that was credited individually, they will withdraw it to cash. Uh, Narration will be cash withdrawn by A and B equal to their share of goodwill. Now here comes the third case, when 50% of the amount of goodwill is credited to the to existing partners is withdrawn. In that case, first entry will be same, second will be same, the third entry, only the third entry will be same as passed in the second condition, but with the half amounts, that is A's capital account with 1,250, B's capital account debited will be 750, and to cash 2,000. So here the cash withdrawn for 50% of the share of goodwill. Again, that note is given. It is assumed that the sacrificing ratio is same as the old profit sharing ratio of the partners. Now here again one more condition is there, when the goodwill is already existing in the books. That means when the new partner is admitted, only sometimes the goodwill is valued only at that point, but if the goodwill is already existing in the books when the new partner, then what will happen, it is possible that when the new partner brings his share of goodwill in cash, some amount of goodwill already exists in the book. In that case, after crediting the old partners by the amount of goodwill brought in by the new partner, the existing goodwill will be written off. It will be written off by debiting the old partners in their old profit sharing ratio. This is the first condition that will happen. And the second one, if it is decided that the goodwill may continue to appear in the books at its old value, at its old value, the amount to be brought in by the new partner will have to be proportionately reduced. That means he will be required to bring the cash only for his share. He has to bring the cash only for his share of the excess of agreed value of goodwill over the amount of goodwill already appearing in the books. It will be clear with the help of example. Suppose the example we did earlier, the goodwill already appeared to at rupees 8,000. Now suppose if the goodwill is valued at 8,000 and there is no decision to retain it, in that case, after crediting A and B the amount of goodwill brought by C, the following additional entry will be passed to write off the existing amount of goodwill. Means if they are having the goodwill already, so that previous goodwill will be written off with additional entry. Means those 3-4 entries as per the condition will be passed, and the additional entry will be A's capital account, B's capital account to goodwill in their old ratio. 8,000 was there, so 5:3 was the ratio, so 5,000 to A's capital and 3,000 to B's capital. Now again another case. In the case the partners decide to maintain the goodwill account as it is, so in that case the new partner is required to bring his share of goodwill only in respect of the difference between the total value and the book value. So then if in the same example, we if we think that they are maintaining the goodwill account as it is, in that case, like we say, for 1/5 share C brought 4,000, so the total amount of goodwill will be 4,000 to 5 upon 1. That means we will capitalize, the full value will be 20,000, but goodwill at that moment was valued at 8,000, sorry, so the difference was 12,000, and 1/5 of 12,000, that is C's share, will be 2,400. So in that case C will be required to bring only rupees 2,400, and it will be credited to the old partners in their sacrificing ratio. No new entry will be recorded to write off the existing amount of goodwill. So it was up to here the premium method of uh, recording the goodwill. In the coming video we will be doing the revaluation methods. I hope you are getting my video. If everything is clear, please do not forget to like and subscribe my channel. Thank you.